Hello, my name is Andre Sigismondo, and I'm a relationship manager here at Wall Street Alliance Group. Today, I'm here with Keviin Shah and Qihang Yao. Kevin is a financial planner on our team, and Qihang is a registered investment specialist. Over the last week, a lot of questions have been coming in from both clients and prospects with concerns about the most recent market volatility and tariffs. We'll be doing a short educational video discussing the top 5 questions that are being asked. So let's get started. Kevin, what is the reasoning around why there are additional tariffs?
Yeah, Andre, great question. These additional tariffs really boil down to our budget. Every year as a country, we spend nearly $7 trillion, but we only raise about $5 trillion from taxes. So there's about a $2 million deficit or budget deficit. These tariffs are here to increase the revenues, so this deficit is reduced. This is normal, all countries do it. Our goal is to fix the budget to help raise revenues with these additional tariffs.
Great, Kevin. That was great. So, Qihang, with the tariffs coming into play, what are the effects on both the consumer and overall economy?
So the most direct impact of additional tariffs is going to be this increased cost for consumers, especially on those imported goods from the key countries that Trump is targeting for the tariffs. Now, with that being said, there's going to be a rise in geopolitical tensions. We've already seen the retaliatory tariffs from China. We already seen EU's proposal of retaliatory tariffs as well. So there's going to be increased tension there. Now, moving our attention to the stock market. So as of market close on Tuesday, we saw that the S&P 500 fell 15%. The Mag 7 fallen 25%. Now, the tech sector overall has suffered the most. And if you look at the XLK, the sector ETF for technology, it's fallen over 21%. And so it's not just the US stocks that have been affected. If you look globally, let's take a look at the MSCI World Index. As of market close on Tuesday, since the start of the year, it's fallen about 2%. So it's erased all of its earlier gains in earlier this year, and now it's down 2%. Now, however, there's still areas of the market that have done well. So in market volatility, like times like these, the gold sector, for example, the S&P Gold Index is up 12%. Bonds as well, the US Bonds Index is up nearly 2%. So there's still winners and losers in times like these.
Great, Qihang. Those were great insights. Now, Kevin, with these tariffs, what would you say is the best and worst case scenario?
Yeah, Andre, so I like to start with good news. So, best case scenario is the US stays on top as a leader in the global economy. As tariff revenues increase, the budget deficit will decrease, which will allow the administration to work on their ultimate goal, which is cutting the income tax rate. With lower income taxes, along with lowering interest rates from the Fed and less regulation, we do feel that the market is poised to ultimately grow. The worst case scenario is in the short term, we will see more volatility as this trade war continues. If it prolongs, we may see volatility for longer in the market, but this is unlikely because multiple international trade partners have already reached out for talks and negotiation.
Great, Kevin. Thank you for that. Now, Kevin, a lot of clients over the last week have called in a panic, right? And they've asked, should I sell all my stocks? Kevin, how do you navigate these conversations and respond to these clients?
Yeah, Andre, I think this is the greatest time to re-emphasize this is not the time to panic sell because you would be trying to time the market. Timing the market is a mistake, and there's a great example from just yesterday, April 9th, 2025. One headline that tariffs are putting on pause for 90 days made the market jump about 9% in just a few hours. So if you had sold just earlier in the day, you would have missed out on this gain. So do not try to time the market, stay the course. If anything, what we're seeing is this is a time to be buying. It's a buying opportunity to buy some stocks at a discounted price and do what's called dollar cost averaging in your portfolio. So make sure you do not panic sell, stay the course, do some dollar cost averaging, and diversify.
Thanks, Kevin. That was great. So Qihang, if we shouldn't sell our stocks, what areas of the market are we seeing as an opportunity? And that we would recommend to clients to invest in if they have cash on the sidelines?
Well, Andre, we feel that AI will continue to grow under the Trump administration through both a combination of capital expenditure and also less regulation. So because of that, the demand for electricity is still going to remain high. Therefore, utilities companies will still continue to benefit. Now, as far as the energy sector goes, with the recent drop in oil prices, we see that the energy sector is becoming more and more attractive, and therefore, with the combination of deregulation as well as the recent drop in prices, we are still bullish on this sector. Now, finally, financials, we've been saying this, and we say this still, because of deregulation and because of the lowering interest rates, there will be an increased amount of business for big banks like JP Morgan, Bank of America, Goldman Sachs. And because of that, we should see more profitability, and therefore this overall sector is set to do well.
Great. Thank you, Qihang, and thank you, Kevin. Appreciate it.
Yeah, so thank you everyone for tuning in today. To just summarize what we've spoken about, listen, we've seen all of this during COVID time a few years ago, and our partners Syed Nishat and Adil Zaman have been speaking about this in their interviews and in their recent studies. You'll also see our partner Adil Zaman in panels like CNBC, Bloomberg, and Fox Business News giving our outlook. We have predicted this. We have predicted that the market will go down because of these tariffs. It happens, but ultimately, this is not the time to panic sell. This is the time to be diversified because volatility is here to stay for a while in the market. You need to ensure that your portfolio is diversified across sectors of the market like Qihang spoke about and not concentrated in any one individual stock. If you look at the S&P 500, over about 30% of it comes from just the Magnificent Seven. So stay diversified with areas of the market like international, gold, and utilities to ensure that your portfolio has breadth. Speak to your financial advisor and your relationship manager to navigate these challenges and ultimately stay invested according to your investment objectives. Don't panic sell, stay diversified, and stay the course. Thank you everyone for joining us today.